Hello everyone, I am from the Bodhi Academy and today we'll be learning chapter 7, that is money and banking. Okay, so here we'll be learning about evolution of money and we'll be learning how the money has evolved from a different period of time. Okay, so why there is a term called as evolution of money. Now in order to improve the difficulties of barter system, earlier we were having this system wherein people used to exchange goods for goods. Okay, goods, exchanging of goods for goods, exchanging of goods for goods. This is called as barter system, and in this barter system there were a lot of issues, okay, which people were facing. So money has only been in a use from last 3000 years. Before that, barter system they were using. So barter system is a system where goods were exchanged for goods, but this proved to be an inefficient system of exchange, and it is then that the man invented money, which was commonly accepted as a medium of exchange. So barter system is an exchange where goods or services, these are directly exchanged for other goods or services without using a medium of exchange. Now there are a lot of drawbacks for barter system. We'll be studying what are the different drawbacks of barter system. First one is difficulty of double coincidence of font. Okay, the first difficult of double coincidence of fonts. So this is the first drawback, double coincidence of wants. Okay, this means that the goods in possession of two different individuals are needed by each other. Okay, so this is a double coincidence of want. Second one, in a barter system, what happens is, like, if that particular person having a surplus amount of commodity, okay, then the other person, he will expect that that particular other person should also have the that much of surplus amount what he has. Okay, so that double coincidence is not used to happen in the case of barter system. Then the second one is lack of system for future payments. So in the barter system, there is a lack of any satisfactory unit of exchange in contracts involving future payments. Okay, so the second point is this lack of system for future payment for lack of system for future payments. Third is lack of common unit of value. Common unit of value is like it's very difficult to find out the exchange value of a commodity in terms of other goods and services which is available in the market. Okay, then so this is the third point, that is lack of common unit of value. Lack of common unit of value. Then fourth one is lack of system for storage. Lack of system for storage. Storage in the sense, barter system do not provide, it do not provide any method for storing of purchasing power for future holding stock of any certain commodity. So this is a lack of system for storage and transfer of values. Then the next point, what we'll be studying is with regards to, there are different functions of money. Which are the different functions of money? The first function is primary function and secondary function. Functions of money. Primary function, and then we have got secondary function. Now, primary function is the main function. Okay. Secondary function is a subsidiary function. So secondary function is a subsidiary function and primary function is the main function. What is the primary function of money? First one, money act as a medium of exchange. Okay, so medium of exchange we can say, wherein in medium of exchange money act as a medium of exchange for a goods and services. If you want to purchase anything, then we can purchase it through by giving the money. Okay, so money helps people in buying whatever the commodity people want, okay, or consumer want. Then the second one is measure of unit or value. Measure of value or unit of value. So, money is the unit in terms of which the value of all the goods and services, this is measured, okay, and it is expressed. So, this is called as, these are the two primary functions what we have, medium of exchange and measure of value or unit of value. Then the next we have got is subsidiary function. Secondary function is also called as subsidiary function. So the first point under this is standard of deferred payment. Standard of deferred payments. So money act as a standard of deferred payments. Like if we can take the loans and then we can repay it in the future. So repayments are done in the future. Okay, in terms of money. So that's why we call it as a secondary function. Then next point is store of value. So money helps to store of value. Store of value is like a store of value implies shifting of purchasing power, okay, from the present payment to the future. So money helps to store value or wealth, which is a source of future payment, future investment. So in the barter system, because goods, they perish, they do not stay for a longer period of time, perish and wear out, and this was difficult. So money, it can we can store it as a in the form of credit cards or and no and the storage and its storage does not need much space. Okay, so this function is called asset function of money. So store of value is called as asset function of money. Then the third one is transfer of value. So money act as a mode of transfer of value from one place to another. So the third function of this is transfer of value. Okay. So these are some of the functions, secondary functions of money, and the primary functions are medium of exchange, which are called as main function, and measure of value or unit of value. Okay. Then we have to understand who are the producers of money. Producers of money refers to the suppliers, okay, of money. And who are the suppliers of money? We can say that suppliers of the money are the government of the country and the banking system of a country, which includes the central and the commercial bank. Okay, the central and the commercial bank are very important in the world of economics. Central bank, which is the apex bank, or we can call it as bankers bank. Then we have something called as commercial bank. Okay. Coming to the distinction difference between the commercial bank and the central bank. A commercial bank functions according to the rules and regulation. So whatever the rules and regulations set up by the central bank, okay, this rules and regulation has to be followed by commercial bank. Okay, rules and regulations. These rules and regulation has to be followed by the commercial bank. The central bank, as I told, it is the apex bank. Then a commercial bank aims at profit maximization. Okay, so commercial bank, the main motive of this is profit maximization. Then the main motive of the central bank is to do a social welfare. Okay, they see, central bank sees that there is maximum social welfare of, okay, of the people. So, and commercial bank basically they focus on profit maximization. Then commercial bank only execute the monetary policy. Whatever the policies framed by the central bank, only these policies are being followed by the commercial bank. Wherein the central bank, it designs and controls all the instruments of monetary policy of the country. Okay. Further, we'll be studying about which are the different instruments of monetary policy. Okay. Then, the commercial bank, it does not perform this function. The central bank is the custodian of foreign exchange reserves of the country. Then, a commercial bank has no authority to issue currency, wherein central bank issues currency. Issues currency. Commercial bank has no authority to issue currency. So these are some of the important points what we have to learn in while giving the distinguish between central and the commercial bank. Okay. Coming back to the um different functions of money, what we saw. Coming back to the who are the producers of money. Producers of money refers to the suppliers, as I told, and who are the suppliers of money. They include government of the country and the banking system of country, including the central and the commercial bank. Then we have to understand which are the different motives of demand for money, or which are the different motives of holding money, or explain the motives of liquidity preference. Okay, so motives of demand for money, very important point. Motives of demand. So the first one is transactionary motive, second one is precautionary motive, and third one is speculative motive. Okay, like motives of demand for money. First one is transactionary motive. Okay, so transactionary motive, the only thing we have to remember here is this is for day-to-day expenses. The money is kept for day-to-day expenses. Okay, so here we can see that people demand money in cash or form to meet their day-to-day transactions. A firm or an individual receives income at a fixed time, but spending is spread over a period of time. Okay, so this is called as transactionary motive. Then the next one is precautionary motive. As the word says, precautionary. Okay, as the word says, precautionary, here um, individuals and firms demand money in cash form to meet any unforeseen circumstances, like which are there are, there are a lot of uncertainties which can come, like flood, drought, or accidents. So to meet all these expenses. Precautionary motive is one of the demand for money. Then third one is speculative motive. Speculative motive, and this is for the traders and businessmen. Here they make estimates regarding the future prices. Okay, so basically they deal about the speculations of money here. So, speculative money. Speculative money is basically for traders and businessmen. And here all the estimates are done with regards to speculations of money. Okay, all the estimates are done with regards to speculations of the money. So this is called as speculative money. Next, there are different measures. In this chapter, what we have to focus more in measures of money supply. There are different measures of money supply: M1, M2, M3, M4. These are the different measures of money supply. Okay, there are four measures or measurement of money supply. So, four measures of money supply. So which are the four measures of money supply? First one is M1. M1 includes C plus C in the sense cash. D is for demand deposits, and plus OD. OD is some other deposits, like these are other deposits which includes OD is other deposits. So other deposits which includes demand deposits of any public financial institutions like Industrial Development Bank of India. So this thing we have to remember in case of M1. Then the next one is M2. M2 includes this M1, and M1 we know what comes in M1, that is cash, demand deposits, demand deposits. So M1 includes cash plus demand deposits plus some other deposits. Okay, and M2 also includes savings deposit with post office saving bank. Okay, saving deposit with post office saving bank. So whatever the income we have with regards to post office saving bank, that is included in M2. Okay, then M3 is next measurement is M3, money supply M3. Okay, this includes M3 includes M1 plus net time deposits with commercial bank. Okay. Net time deposits with commercial banks. Okay, so this is M3. So M3 is also called as broad money, and M1 and M2 is called as narrow money. Okay, so narrow money is M1 and M2. M1 and M2 is called as narrow money, and M3 and one more M4. So M4 includes M3 plus total deposits with post office. So this is called as M4, total deposits with post office. So M3 and M4 is called as broad money. Okay. So these are some of the measures of money supply. Okay. Then here also we have to understand which are the primary functions of bank. So primary function is its advance deposit and it lends the money na, to the people. So primary functions of money, advancing deposits, so advancing deposits, uh, or we can say accepting deposits, accepting accepting deposits is the first one. A bank accept deposit from the public and people can deposit their cash balance. Okay, people deposits their checkable or non-checkable deposits. So here the in checkable deposits checks are issued and non-checkable deposits are those against which check cannot be issued. Okay, and so therefore it cannot be withdrawn at a time. So instead, money in this deposit is kept as a reserve with the bank for some fixed period of time. So this is called as accepting deposits. The next is advancing notes. So any primary function of the commercial bank. The second one is advancing loans. So it gives the loans now, gives loan to the common people. Bank advances loan mostly for the productive purpose. Okay, so bank advance loan mostly for productive purpose against some approved security, and the amount of loan is generally less than the value of the security. So it is important to note that loan amount is never paid in cash. So all the loans are reflected as demand deposits here with the bank. Okay, so these are some of the functions of commercial bank. Then a financial institution is not a banking institution if it does not perform the two primary functions. First one is accepting checkable deposits and second one is making advances or offering loan. Then there are different types of deposits with the commercial bank. People have their current account, saving account, fixed deposits account, recurring deposits, then central bank. Okay, so these are some of the types of deposits which we have to understand. Then, which are the functions of central bank? As we have seen that the difference between the commercial and the central bank. Central bank is the apex bank and its focus is on the social welfare. So functions of central bank, it's a banker's bank and it issues notes to the country. So central bank was known as the bank of issue. The notes issued by the central banks are unlimited legal tender. Then it's central bank is a banker, agent, and it is a financial advisor to the government. Then it is also a custodian of foreign exchange. The central bank is custodian of nation's reserve and it maintains the foreign exchange reserves. Bankers Bank, so since it is a apex bank and the central bank they has some cash reserve of the commercial bank. Okay, so as a compulsory deposits with them. Then it also supervises the commercial bank and it is also called as lender of the last resort. It means that if a commercial bank, if they are failing to get any financial accommodation from anywhere, the central bank, it gives the loans to the commercial bank. Okay, and this we have seen what are the difference between commercial bank and the central bank. Then um, instruments of monetary policy, or which are the different quantitative measures of um, of monetary policy, or will see qualitative measures of monetary policy. So these are some of the main things what we have to remember: bank rate, open market operations, cash reserve ratio, statutory liquidity ratio. Bank rate is the rate at which the central bank it gives credit to the commercial bank, that is called as bank rate. Then open market operations. Here in open market operations, the securities are purchased and sale. So it is called as selling and purchasing of any securities. Then CRR is a cash reserve ratio in which a minimum percentage, a certain percentage of amount has to be maintained by the commercial bank with the central bank. So what a commercial bank does, they keep a certain deposits, okay, with the central bank. Then SLR is statutory liquidity ratio. So if every bank is required to maintain a certain fixed percentage of its asset in the form of cash with themselves. So here a certain amount of asset is maintained by a commercial bank with themselves. Certain amount is maintained by bank with themselves. This is called as SLR, statutory liquidity ratio. Then we'll see which are the qualitative measures, like margin requirement. Margin requirement, here we have to understand that this is the difference between the current value of security which are offered for loans and the value of loan which is granted. So this is a margin requirement. This can come as an MCQ type of question, or they can ask which are the different qualitative measures of monetary policy. Then moral suasion. Sometimes the central banks they make the members bank agree through pressure to follow the own principles and directives. Okay, so the banks they are advised to restrict the flow of credit during inflation and to be liberal in lending during deflation. Then rationing of credit, it refers to the fixation of credit quotes for different business activity by the central bank, and it is a method by which the central bank seeks limit, okay, to the maximum amount of loans and advances. Then, direct action means if any bank is not following the principles or the rules and regulation of as given by the central bank, then direct action may be taken against that particular bank, and that particular bank can be removed as the member of the country's banking system. So this is called as direct action. So with this, we have finished with the money and banking chapter. So only thing is that here you have to remember the which are the drawbacks of barter system, different functions of money, how the evolution of money has been done, then which are the functions, primary and the secondary function, then the difference between the central bank and the commercial bank, then which are the different motives of demand for money, that is transactionary motive, precautionary motive, speculative motive. And these are very important question, which are the four measures of money supply: M1, M2, M3 and M4. And M1 and M2 is called as narrow money, and M3 and M4 is called as broad money. Okay, thank you for watching my video.